This financial statement analysis is provided to you by Anastasia, Teemu, and Tra. We chose BMW and Volkswagen as our case companies in investor point of view, and Honda and Ford on lender's point of view.
So from the investor viewpoint, we chose the profitability indicators to make our analysis. First of all is the price to earning ratios. A high ratio suggests that investors are expecting higher earnings, and then a lower can mean that the company can be undervalued or is doing exceptionally well to its past trend. And as you can see, both BMW and Volkswagen are doing way better than the industry average, and especially they are like growing in a opposite way of the industry average. And for net profit margin ratio, it tells you how much money a company makes for every 1 euros in revenue. And as you also can see, BMW and Volkswagen are doing much better than the industry average. And why the industry average are declining, both BMW and Volkswagen are growing in net profit ratio. And for the next one is asset turnover. Asset turnover calculate the total sales of each euro of an asset. It shows how efficient a company is in using an asset. BMW and Volkswagen doesn't have much different in between, but then they're doing a little bit worse than the industry average. Return on equity. Um, it shows a company's net profit return to a shareholder equity. And for BMW and Volkswagen, in 2016 they are doing way worse than the industry average, but to 2017, while industry average is declining so much, both BMW and Volkswagen are doing better. And at the end, we think that both BMW and Volkswagen are really profitable, but if we have to choose, we would go to Volkswagen. Yet it's look like they still have more room for growing potential because the stock are currently undervalued compared to both BMW and the industry average.
It is important that the money that they have lended is paid back, of course, with the interest that they profit of. Liquidity of the company is crucial when it comes to the lending money for the companies. Quick ratio and current ratio are ways to measure the liquidity of the company. The quick ratio measures how well current assets are able to cover the current liabilities. Current ratio tells about the company's abilities to pay short-term liabilities. Earned ratio and working capital are also important liquidity indicators. As you can see, the Honda earns the interest back much more effectively than Ford, which means that they earn more with the money lended that they have to pay for it. Working capital shows that Ford is a much bigger player in the market and that they have capital to support their operations. All the numbers in the chart are in millions of USD. A rising debt-to-equity ratio implies higher interest expenses, and that beyond a certain point, it may affect a company's credit rating, making it more expensive to raise more debt. Ford has really high debt-to-equity ratio, over 10 times higher than the average company in the industry, which is really alarming for the lenders. Debt ratio measures the percentage of a company's assets that have been financed with debt, both short-term and long-term. Ford's degree of leverage is quite a lot higher than the average on the industry, and in comparison, lending money for Honda is a lot less riskier than lending money for Ford. Equity ratio that measures the amount of assets that are financed by owners' investments by comparing the total equity in the company to the total assets. This means that the business operations of Honda are much more sustainable than Ford's, as if they would pay all of their debts, the investors would end up with more assets in the end.